The stock market isn't just numbers. It's a story of people, greed, and opportunity. Some people make millions, but some lose everything. Today, we'll break it down so simple, even a 5-year-old could understand. Imagine a giant store, but instead of apples or shoes, people buy pieces of companies. These pieces are called stocks. If you own a stock, you own a small part of that company. Your money helps the company grow, and if the company grows, your stock usually grows too. If the company struggles, your stock may lose value. It's not just numbers. People make the market move, not magic formulas.
By the end, you'll see the stock market like never before. You can buy stocks when prices are low and sell when they rise. Stock prices depend on supply and demand. More buyers, prices go up. More sellers, prices go down. The stock market can swing up and down very fast. That's called volatility. Investors who hold stocks for years often ride out the ups and downs. Some stocks pay dividends, a small part of company profits to shareholders. Indexes like the S&P 500 track many stocks to show the overall market trend. A rising market is called a bull market. A falling market is a bear market. People buy and sell stocks through trading platforms online. Higher potential rewards come with higher risks. Next, we'll see how even small investors can make big impacts. Even small investors together can move markets. Buy orders and sell orders determine how the price moves. Sometimes people panic. That can cause sudden drops. After big rises, markets often correct themselves downward a bit. Companies sell stocks for the first time in an IPO. Public companies sell shares, private ones don't. Sometimes stocks split to make them more affordable. Sometimes prices rise too fast, forming a bubble that may burst. Crashes happen when prices fall very fast. By studying past markets, investors learn to make smarter choices. Some investors trade daily, others hold stocks for years. Markets have trends, upward, downward, or sideways. Spreading investments reduces risk. This is called diversification. In a bull market, optimism drives buying. In a bear market, fear drives selling. News can move markets instantly. Insiders sometimes have info before others, affecting prices. Some traders profit when prices fall. This is called short selling. Traders use charts and patterns to predict future moves. Others study company financials to decide whether to buy or sell. Most people enter the stock market with one simple question: how does money grow here? To understand that, we need to understand companies. A company is just a group of people solving a problem. They make something people want. People pay money for it. If they earn more than they spend, they make profit. But running a business costs money. Sometimes companies win, sometimes they lose. Now, here's where the stock market comes in. A stock means owning a tiny piece of a company. When you buy a stock, you buy one of those pieces. That makes you a part owner. Companies sell stocks to raise money. They use that money to grow. If the company grows, your piece grows too. That's why stock prices move. But price isn't just logic, it's also driven by emotions. This is called supply and demand. Every trade needs two sides. Buyers want the price to go up. Sellers want to lock in profits. The market matches buyers and sellers. When both agree, a trade happens. That trade sets the new price. Thousands of trades happen every second. Put those prices together and you get a chart. People watch these charts closely. Sometimes they overreact. News can push prices fast. Fear spreads quickly. So does greed. Markets move in emotional cycles. Hope, fear, panic, recovery. This confuses beginners. But zooming out helps. Over time, markets tend to grow. Patience matters. This leads to two different approaches. One path is trading. Traders focus on short-term moves. They react quickly. The other path is investing. Investors think in years. Same market, different stress levels. Short-term prices jump around. Most of this is just noise. Zooming out removes the noise. What remains is the trend. Beginners chase fast profits. They often buy high and sell low. This pattern repeats. The market rewards patience. Time does the heavy lifting. But risk never disappears. It comes from uncertainty. That's why smart investors spread risk. This brings us to diversification. Every second, buyers and sellers meet. Buyers want the lowest price. Sellers want the highest price. The price moves where they agree. That moment becomes the market price. This happens thousands of times a day. That's why charts look alive. To beginners, it looks random. But there is a system. Let's break that system down. There are two main ways to trade. A market order buys instantly. You accept whatever price exists. A limit order sets your price. You wait until the price comes to you. But it might never happen. Speed versus control. In fast markets, this matters a lot. Beginners often ignore this. That's okay, let's keep going. Now comes a quiet but powerful idea. It's called liquidity. Liquid markets have lots of buyers and sellers. Prices move smoothly. Illiquid markets are thin. A small trade can move the price a lot. That surprises beginners. Experienced traders expect it. Liquidity exists on a spectrum. Big companies are usually more liquid. Small ones can be risky. Same rules, different behavior. Liquidity shapes volatility. This matters more than you think. Now, let's add news. Markets react to news, especially earnings reports. But prices move before the news, because markets guess. If good news is expected, the price may fall anyway. It's about expectations. Sometimes markets overreact. Then they correct. Long-term investors zoom out. Short-term traders feel every move. Same market, different experience. Over time, information settles. Markets are forward-looking. Now, let's talk about risk. Risk exists on a spectrum. Low risk, steady growth. High risk, big swings. Diversify to reduce risk. A balanced portfolio spreads risk. Overconfidence is dangerous. Fear makes people sell. Greed makes people buy too much.
In the end, investing is more about behavior than brilliance. Emotions create chaos, but logic creates clarity. Patience rewards those who wait. Diversification protects you when markets move unexpectedly. Balance keeps both your portfolio and emotions steady. Mistakes are not failures, they are lessons. Short-term panic often leads to long-term regret. Long-term patience builds real growth. Markets move in cycles. Understanding this changes everything. Overconfidence can be just as dangerous as fear. Logic provides direction when emotions pull you apart. Spreading risk creates stability. Consistency matters more than timing. Every step forward compounds over time. Successful investing is simple but not easy. Patience, logic, and diversification work best together. Start small, but stay consistent. Knowledge grows when action follows learning. Investing is a journey, not a sprint. Keep learning, stay patient, invest wisely.